Hello, everybody, and thank you for being here with us. My name is Abby Cruz King. I'm with Myriad, and today I am excited to have my co-hosts Mike and Laura from Tax Law Associates. They're a really good partner of Myriad, and today they're going to tell you everything you need to know about taxes. Just a reminder, this webinar will be recorded, and we'll send it out via email afterwards. And there will be a link in the chat and in the email for you to set up an appointment with Mike and or Laura. So I will let them take it away and introduce themselves and begin their presentation.
Okay, so I'm Mike Fussell. I'm a tax attorney and a CPA. I have been a CPA in the state of Georgia since 1996. I'm a member of the Illinois Bar since 1999. I also have a post-Juris Doctorate degree, which is a Master's of Laws in Taxation. And I have spent my career focusing on the closely held business community and building tax strategy models that will create an annuity of tax savings. And so we're going to talk a little bit today about how those things work. So entity structure lays the foundation for the different types of tax attributes that run to that type of company. For example, a sole proprietorship has got certain tax attributes that run to that type of structure. A partnership is different. An S corporation is slightly different than a partnership. And then you've got C corporations, which tend to be publicly traded companies, and they've got different tax rules than those others. And so what we are good at doing is blending these different sets of rules based on entity structure in order to effectuate the best outcome for you. So let's talk about the different avenues that you would look at with regard to your entity structure. For your operating businesses, which is your financial planning services, I think for most of you guys, you're going to want the profitability of that business to run through a flow-through entity. And so your typical options are a limited liability company or an incorporated business, and then you've got to determine how that entity is taxed. So a limited liability company, it defaults to be taxed as a sole proprietorship absent you making any other election. And a limited liability company that has multiple partners, it defaults to a partnership status, which files a Form 1065 unless you make alternate elections. One of the elections that you can make if you're a limited liability company is you can elect to be taxed as an S corporation. You do that by filling out a Form 2553, which is basically the IRS's form saying, I, as the taxpayer, elect to have my entity taxed as an S corporation versus the default structure, which is a single member limited liability company defaults to a sole proprietorship. A multiple member limited liability company defaults to a partnership. I said that wrong. The single member defaults to a sole proprietorship. The multiple member defaults to a partnership structure. Now, the value of the partnership structure is that partners can allocate gains or losses any way that they so desire. If you're a single member LLC taxed as a sole proprietor, the upside there is you don't have other equity partners that you have to negotiate with. The downside is that if you're taxed as a sole proprietorship, that's an expensive way to be taxed. First and foremost, the sole proprietorship, it calculates self-employment tax on all of the earnings of a single member limited liability company, and that self-employment tax exposure is unlimited. Same thing in a partnership. If you have multiple partners, the partnership will calculate self-employment tax to each one of the partners based on their respective earnings during that year, and the self-employment tax calculation is unlimited. And so one of the values of making an S election is that you have to take a reasonable compensation inside of an S corporation, but distributions out of an S corporation are not subject to self-employment tax. And so if you make the election to look at being taxed as an S corporation, you over the long term can save self-employment tax dollars because your salary, it needs to be a reasonable salary under the reasonable compensation rules, but you would only pay payroll tax on the salary. It would avoid self-employment tax on the distributions of the S corporation. So your entity structure decisions are very, very important. Secondly, Asset protection, it goes hand in glove with your entity structure analysis, because if you segregate assets in a separate entity, then the risk of those assets runs to that entity typically, as long as you are following your corporate formalities and you've got your ducks in a row, so to speak. For example, if you own your own office building, it may make some sense to segregate the office building from your operating business, because if there's something happened and somebody had a slip and fall on your property, then that slip and fall would run to the entity that owned the business. It would not run to your operating entity for where you're practicing as a financial planner. And so asset protection is very critical with regard to how we house our assets in different entities in order to protect assets from other assets housed in different entities, if that makes sense. And so asset protection is critical when you're doing your entity structure analysis, and the goal there is to identify what assets do we have, what assets do we aspire to, and make sure that we do an asset protection determination on what is the best route for us to house those assets in order to protect them from other assets and from other folks. For example, if you've got employees, and the larger your headcount is, the employees themselves have risk associated with their operations in your business. And so not only does it sometimes make sense to segregate our property, plant, and equipment, such as vehicles or real estate, into a separate entity, but we also would look at housing the employment of our risk from our employees in a separate entity. And so housing those separate asset classes in different entities also gives us the ability to blend the different tax rules that run to the different tax entities. And so what we are astute at doing is helping you make those determinations and assessments as to which assets we want to protect in which corporate solution. And in doing so, we then would maximize our opportunity to have the blended set of tax rules, and that will give us an advantage over the course of the development of our career. And so just as an overview standpoint, we typically want to have your operating income in an S corporation because we get a self-employment tax benefit that we just discussed earlier. We typically would put real estate holdings in a partnership structure because rental income is passive in nature and not subject to self-employment tax. So our operations typically would be in an S corporation. Real estate holdings would typically be in a partnership. If we had property, plant, and equipment, which most financial planning guys don't have a lot of, but let's say if you were a manufacturer, it may make some sense to put the manufacturing equipment in a separate entity to protect it from our other asset classes. Now, the reason that we want our real estate and our property, plant, and equipment and our operations in a flow through is for succession purposes. Someday when you get ready to make your retirement decisions, you are going to want to have the flexibility to do what's called an equity transaction or an asset sale. And so the sellor of a business that owns a certain class of assets, the sellor would prefer to sell the equity, the company equity that holds those assets, because there would be no depreciation recapture and it would give you an advantage for succession to sell the equity. Purchasers of businesses that own assets. Purchasers of businesses that own assets prefer to buy the assets rather than buy the equity. So not only do we want to build a model to show you from an operational standpoint what's best for you to save taxes and to house asset protection decision making, but we also want you to make determinations when you make your entity structure analysis from the outset. We want to have in mind the different alternatives with regard to succession, because when we retire someday, we don't want to have assets that are in a restricted type of entity that would cause us succession problems when we get to making those decisions. And so that all needs to be determined from the get-go in order to effectuate the best opportunities for you in the long run. Secondly, if we engage with clients that have already made entity structure decisions, we want to revisit with them the context of which those decisions were made, and to make sure, number one, they were the correct decisions, and number two, that it also encompasses in the future succession planning, and we also want it to encompass our potential estate tax exposure. So succession covers retirement decisions. Estate planning covers what happens with your assets once you are deceased and how do they transfer to your heirs. And there are a multitude of different options that are available to you in the estate planning area. So just to review with you guys, entity structure and asset protection go together. We want to house our assets in different entities in order to protect our assets from different asset classes. And that includes not only tangible property, plant, and equipment, but real estate, operations in the business, and our risk of our personnel. And so ideally, we would like to have access to partnership rules, S corporation rules, and we would also like to have access to C corporation rules. A C corporation as an entity is a little more complicated than the flow-through status entities because C corporations are subject to double taxation. Double taxation can be a real problem. So when you are identifying how you would utilize a C corporation in your corporate mix, that needs to be done very carefully. Because if we were to house an operating assets inside of a C corporation and those assets became more and more and more productive over time, generating more and more profit over time, we could trap those in a C corporation, which is double taxed. Our tax rate could be astronomical if it wasn't orchestrated correctly. And so now you need to know this. Closely held businesses, by and large, are S corporations, which is the correct decision. Publicly traded companies are by and large C corporations because there are limitations with regard to the number and types of shareholders inside of an S corporation. Now, publicly traded companies have got all of the liquidity in order to lobby Congress in order to create statutory tax breaks that are very favorable, not only to publicly traded companies, but to any type of entity that is a C corporation. Many folks don't know and don't realize that once you elect to flow through status, whether you're an LLC tax as a sole proprietorship, an LLC tax as a partnership, or an S corporation, if you own more than 2% of the equity of any of those flow through entities, you are precluded by definition from using publicly traded fringe benefit rules and statutory tax breaks. And so what we are astute at helping you do is identifying how do you fix that. And so a lot of folks are told to set up your operating entity as an S corporation, which is the correct decision, but then they often just stop right there. And so that does give you the benefit that we talked about earlier of self-employment tax breaks, but you then have elected to forego fringe benefit rules and all the other statutory lobby tax breaks that are available to you, because by definition, if you own more than 2% of the equity of a flow through, you can't use those rules. And so it is very, very common that folks have had the self-employment tax benefits, and they have one layer of asset protection protecting their operations, but it's not at all uncommon for all of their asset classes, with the exception of their personal residence, to be in that one entity. And so that is not necessarily the optimum choice for you, because it ties your hands with regard to tax savings opportunities, because we only have one entity and only one entity set of rules. Secondly, if we have only one entity and all of our assets in that one entity, all of our assets are subject to each other's assets, including property, plant, and equipment, real estate, personnel, and operations. And so when we're approaching a client and trying to help educate them on these things, we offer a service that does a tax savings analysis that will give us an opportunity to review your entity structural choices, or the lack thereof in some cases, and help you identify different alternatives that would create an annuity of tax value to you every single year. And so that tax savings analysis is something that I would implore you guys to look into and to take the time and energy to gather some tax documentation, both corporately and individually, and let us look over your shoulder and help educate you with regard to what your options may be. And a multi-entity structure is where we typically end up, because we need access to partnership rules, S corporation rules, and C corporation rules. But the way you go about doing that and the way you manage those is critical. So make sure that we are not increasing your tax rate other than reducing it. Now, we also want to address with you retirement planning. And to those of you that are in the retirement planning business, you are astute at that stuff and know what you're doing. Where we have run into issues with regard to financial planning folks in the past, often the financial planning guys will maximize their retirement opportunities for the business that they're in. But if you've got partners, and a lot of times we've got cost sharing arrangement with our administrative staff, our rank and file folks, and we sometimes have our multiple partners in that business. We've got to be cognizant of discrimination rules with regard to retirement planning and or other fringe benefit related items have got discrimination provisions in them. So where we've got to be careful is that we don't have a cost sharing business that we're partners in, and then we have our financial planners each have their own S corp, for example, and each of the partners has a differing retirement plan, but we don't offer a retirement plan at all in our cost sharing entity of which we're partners. I believe that creates discrimination. Not believe, it creates a discrimination problem that can cause you audit risk if that's not well managed and maintained. And so entity structure, asset protection go together. That's critical to lay the foundation in order to build a tax savings model. But then you also need to look at retirement planning, succession planning, estate planning, and what we refer to as employee benefits or employee retention options. And so if you have a blended entity structure, we can effectuate all of the different tax outcomes as long as we have access to them when we made our entity structure decisions, if that makes sense. And so often people will set up their entity to start with, and they go right to work. And the entity analysis is never really reviewed again, and it is not at all uncommon for people to approach us at Tax Law Associates when they're at the zenith of their career and they're looking at succession options, in other words, packaging their business to sell it either to a third party or related party, which we're happy to do. But when we get into the entity structure analysis, I can't tell you how many times that people have not addressed that, and now they're literally at their retirement stage, and we say, gosh, you know, what if we had done it this other way, it would have increased your net worth over the course of your career because it would save you taxes annually. And so now let's talk about basic tax savings. The best type of tax savings is to identify a tax statute that gives you the ability to extract cash on a tax-free basis. And there are many different statutes that give you the ability to do that. You've got to have the right company to get to the right set of rules, but you want to be extracting cash on a tax-free basis based on the avenues that have been available to you based on statute. And that needs to be done every single year. Secondly, we want to make sure that you are appropriately deducting everything that you're capable of deducting. And now, in the closely held business community, often people are deducting more than they're eligible to deduct, and those things typically turn on entertainment-related items, such as we've got the golfing folks, and we've got folks that are into hunting, we've got guys that are big into sporting events, and all of that is business, according to them, but we've got to be careful that if it's too much entertainment-related and there are not business purpose with regard to the expenditures, they may not be deductible. And so if we need to create business purpose because we have hobbies that we really enjoy, we need to make sure that we are promoting and or conducting business if we're going to take those deductions. And so those are kind of bread and butter things that we cover with folks when we move forward. Now, just to reiterate what I've already told you, this discussion is designed to highlight for you the way that tax strategy works most effectively. But in order for us to help you further, we would like to have an opportunity to have a one-on-one conversation once we've had an opportunity to look at the decisions that you've made and the tax strategies that you have pursued or not pursued, and then for us to do an analysis, and we'll give you a savings verification report that shows you, had you had the structure that we feel is most applicable for you, how much money are you leaving on the table annually? and that is a fairly easy context for us to work in. If it makes sense from that point and you want to go further, then we will build a deliverable that outlines for you how that works. And those tend to be fairly substantial documents because it covers entity structure, asset protection, succession planning, estate planning, retirement planning, and we bundle all of that into one deliverable. So it covers a great deal of stuff. It takes us several weeks to a month and a half to accumulate all that data and to build that level of a report. But we've been at it for quite some time. And I wish I could tell you that I invented this stuff, but I had nothing to do with it. I was the tax firm that I was associated with in Chicago. They predominantly did tax strategies for closely held businesses, and those guys trained me from the ground up. And I've been at this from, including my CPA career, for 27 years now, and can't believe it's already gotten that long and that late. Another thing, in the event that you guys have got a tax defense problem for either you or your clients, I am a member of the United States Tax Court. We do tax defense work. We prefer tax strategy work than tax defense work, but should you run across something to that effect, we would be willing to look into what options we may be able to help people on a tax defense basis if that's warranted. I covered a lot of stuff, so if there are questions or concerns or further discussions that need to be had, please click on the link and either have us make an appointment to do a tax savings analysis and/or to have any further discussions that we may need to have to flesh out what I've attempted to explain to you to the best of my ability here today. Are we taking questions and answers, or do we have anything that, Laura, you would like to add as far as scope of our discussion today?
I can add a little bit. Basically, I want to let you guys know what we are not. We are not here to replace your CPA or your accountant. The team that you have in play stays in play. We just partner with you and them to become the ultimate tax team. And we are not a company that works in the gray area. Everything that we do is statutory, black and white, by the books. And we are not a retainer service. Everything that we do as far as implementation and things of that nature is all based off of how much we can save you. Again, we are going to send you an email to schedule your personalized tax consultation. I will meet with you to gather some information and kind of go over what the next steps are and what to expect. So be sure to click that link and register. We would like all partners involved on that meeting. It just helps everything move smoothly. So if everyone can get together, pick a time, I'd love to meet with you and kind of talk about your personalized tax outlay. And that's all I have. Mike, thank you so much. That was amazing and very informative. Abby, we appreciate our relationship with Myriad, and we look forward to talking soon.
Awesome. Yeah, Mike, that was a ton of information. So if you're following along and you got a little lost or overwhelmed, don't worry, because we recorded this webinar. You can reference it whenever you need to. And we will be setting that up in a follow-up email. So just keep an eye out for that. That's all the time that we have for today. I think we all learned a lot. And a big thank you to Mike and Laura for being on today. And I hope everybody has an awesome day.
Have a great day, guys. Thanks for having us.
Thank you.
Bye.
Bye.